Dear friends, this is Advocate Srimanarayana Malala, not a normal advocate, people's advocate. This is People's Advocate Srimanarayana Malala. The People's Advocate Srimanarayana Malala is objective mission to serve the people, to marginalized people, do free service, and share the knowledge. Share the knowledge. This is what my goal. My dear friends, you understood about me. First of all, what is our objective? Objective is share the knowledge. Free of cost. Enjoy. Today I'm talking about the portfolio management. Handling the cases about the portfolio management. We are going to solve many cases on portfolio management. My dear friends, we are going to solve portfolio management. Yes, let's go. What are the things is there in the portfolio management? We are going to solve each case. Okay? Understand? Comfort? Yes, let's go. Friends, I would like to go solve now the portfolio management. In the portfolio management, there are various concepts out there. In this portfolio, there are various concepts out there. My dear friend, my objective is to share the knowledge. So I am going to do solve many more problems and solutions on the portfolio management. So while I'm going the portfolio management, my dear friends, I would like to talk what are the concepts over in the portfolio management, what are the formulas over there in the portfolio management. We are going to talk elaborately and solving. See, in the portfolio management, there are 9 concepts is there. Concept number 1, the basic portfolio theory. Concept number 2, security and portfolio beta. Concept number 3, systematic and unsystematic risk. Concept number 4, characteristic line and security market line and characteristic line and security market line. Concept number 5, the factors, sensitivity analysis and arbitrage pricing theory. And concept number 6, optimum weights for the risk reduction. And part 7, beta and leverage. And part 8, portfolio strategies. Part 9, real estate valuation. These are the basically concepts who are in the portfolio management, my friend. First, I would like to talk about theoretically, and then I'm going to solve each and everything before you, my friend. See, if you see what I'm going to tell you, what I'm going to talk to you, you understand, please. See, my dear friends, first, I would like to tell you what are the things covered in the portfolio management. Thereafter, we better to solve each and every problem with reference to portfolio management. So that I'll go like way. Okay, friends, can I start? Dear friend, This is People's Advocate Srimanarayana Malla talking about portfolio management problems and solutions. The lecture on portfolio management. What I am going to do here, first I am going to cover the broadly concepts, and thereafter we are going to plan each problem and solution. See, in the portfolio management, if you see entire problems, there will be three formats. The format one, probability, return, product, deviation, PD square. Probability two security, return, probability, return, product, deviation, PD square, and return, product, deviation, PD square, PDA, PDB. In the format 3, return of the security X, return of the security Y, and XY and Y square. See, the most important thing here, computation of the return. Computation of the return. Computation of the return, computation of the risk and return. Return is equal P1 minus P0 plus D1 by P0. Return is equal P1 minus P0 by P0 plus dividend yield. And other way, risk is equal root PD square. See, my dear friend, our target is to now first complete theoretical things or values is there in the portfolio. Thereafter, we are going to solve case by cases from MTP or something. See, my friend, the covariance and correlation coefficient, the covariance of the AB is equal sigma PDA PDB. The covariation is A is called as variance. The covariance A and B, beta A beta B of X into variance of the market. See, I want computation of covariance A, then A is called variance. The covariance of A and B is equal beta A into beta B into variance of the market. That's called covariance of AB. What is meant by covariance of AB? Covariance of AB is equal beta A into beta B into variance of the market. Correlation of AB is equal covariance of AB divided by standard deviation A, standard deviation B. The correlation range between +1 to 1 to +1 or -1 to +1. Computation of the correlation, the correlation coefficient covariance. See, the diversification or portfolio creation, fast food chain versus health and organic food brand. So the health entity habits, health and organic food will do well and fast food chain will struggle. If such likewise go, if there is a no shift, fast food chain will do well and healthy food will struggle. See, the online railways or online retailer versus brick mortar stores, the performance will be negative correlation. See, the benefits of diversification, for example, business 1, business 2, business 3. Average return 11%, average return 12%, average return 11%. Standard deviation is 21.5, standard deviation of risk is 7.2, standard deviation of risk is 3.7. The portfolio return and risk. Portfolio return is equal weighted average of the individual return. Portfolio return is equal portfolio return and risk The portfolio return is equal to weighted average of the individual return. Understand? What is meant by portfolio return, my dear friend? Mr. X, Mr. Y, Mr. Z? Yes. The portfolio return is equal to weighted average of the individual returns. The portfolio risk, the portfolio risk is equal to not weighted average due to correlation coefficient in case two securities, security 1 weightage of the standard deviation into security 1 weight whole square plus and standard deviation of security 2 and weight of the security whole square plus 2 standard deviation of security 1 and standard deviation of security 2 weights of 1 weights of 2 correlation 1 2. Friends, understand? Let's go. See, the portfolio return and portfolio risk, the notion of the dominance and security dominance, other security. If higher return, lower risk, higher return, same return with low risk. Likewise, we choose the best one. Next, notion and dominance and compensation for the risk. See, diversified portfolio beta based always. For example, you take Trinor ratio. A Trinor ratio is equal to actual return minus risk-free return divided by beta. Friend, understood? Trinor ratio is equal to actual return minus risk-free return divided by beta. Understand, my dear friend? See, my dear friend, what I would like to tell you, this class, we are going to discuss theoretically. Next, another video for accounting standards. Yes. Again, I'll come back to this. We are going to blast today. Today is going, we are going to do well, well. Friends, I would like to come back to discussion. What I could say here, the Sharpe ratio talks about actual return minus risk-free return divided by standard deviation. Whereas a Trinor ratio speaks about Trinor ratio is equal to actual return minus risk-free return divided by beta. Whereas Sharpe ratio is equal to standard return. Sharpe ratio is equal to actual return minus risk-free return divided by standard deviation. Friend, the compensation of the risk. There are types of the risk. One is a systematic risk, another one is unsystematic risk. My dear friend, what I want to tell you here, see, Friend, let me complete this. And then new thoughts come, I'll share it later. First, what in front of us will clear. Okay. Friend, my dear friend, my dear friend, what I want to talk here in this case, see, always the types of the risk is there two types of risk. One is systematic risk, another one is unsystematic risk. The unsystematic risk, a systematic risk, non-diversifiable risk, the risk inherent to the market and will impact the companies in the market. Whereas unsystematic risk is diversifiable risk, the risk is specific to a company and will not impact everyone in the industry. GDP growth, interest rate, inflation wars cannot be eliminated by diversification. Risk specific to company and will not impact everyone in the industry. The poor management, decision, frauds, and friend, this is people's advocate Sriman Narayana Malela, not normal advocate, people's advocate. Okay, people's advocate Sriman Narayana Malela. Okay, so the risk is a specific company and will not impact in everyone in the industry. The poor management decision, frauds, lawsuits, competition can be eliminated by diversification. Measure of the risk, standard deviation, total risk, beta systematic risk. How much does security return deviate from its average return? And considered for friend, the measure of risks. There are two tools for available to measure the risk. One is a standard deviation, that's called total risk. Another one is beta, that's called a systematic risk. Standard deviation is total risk, whereas a beta is a systematic risk. How much does security return deviate from average return? See, considered for undiversified portfolio. Considered for undiversified portfolio. What I want to tell here. If you observe here at the present case, okay friends, today our target is second of NDAS, first of AFM theory. AFM formulas to solve the theoretical questions, practical problems. To solve the practical problem, you must have the formula story of formula of based knowledge to derive, to drive, to solve practical problems. That's what we are going to do. Dear friends, see, the standard deviation is the total risk. The beta is the systematic risk. How much does security, the return, deviate from the average return? A considered for undiversified portfolio. How does security react to fluctuation in the market? Considered for diversified portfolio. So the beta versus standard deviation, how to measure the beta? Yes, the probability information is not given. Then sigma xy minus n into x bar y bar and sigma y square, that's divided by, see, sigma xy minus n into sigma xy minus n into x bar y bar divided by sigma y square minus n into mean of y into mean of y, means sigma y square minus mean y square. See, the probability information is given. Then standard deviation of the security divided by standard deviation of the market into correlation of the security market. That's you need to do. What, whereas covariance of the security market divided by covariance of the market, covariance of the return of the market. See, I would like to tell like this approximately. The beta Eg is equal change in the security divided by change in market. Understand, my friend? Today market is going heavy losses. Today my stocks today it's showing 5,000 loss today. See, overall 35,000. Like this, we can't deal the market. You need to understand how to put investment in the better securities. So that these people's advocate coming and in front of you and talking about the subject matter of the portfolio management. How to maintain your portfolio in order to give best result always. So that you need to calculate the beta. The beta is equal change in security divided by change in market. Beta is risk-free rate written on government security. Multiple risk-free rates aggressive approach, higher number, conservative approach, lower number, moderate approach, average. The risk-free rate is like this. Hello, my dear friend, who watching this your channel? You're understanding? My dear friend, you're understanding or not? Otherwise, call me. My mobile number 9677205265. 9677205265. See, risk-free rate, that is the interest in the rupees divided by value of the per bond. What is hidden in the risk-free return in the question? The security return with beta, zero beta. The beta is called what? Risk only. Understand? Yes, you understood. Yes, let's go. Thank you. See, risk premium of the market. What is meant by risk premium? Market return minus risk-free return is equal to risk premium. That's it. Extra return generated by the market for risk taken. So the positive market is higher than the risk-free rate. A negative market is lower than the risk-free rate. So I could say like this by the end. What I want to tell you that positive market return higher than risk-free rate. Whereas a negative rate, it means return is a lower than the risk-free rate. Understand, my dear friend, who watching this YouTube channel? Yes, you might have understood. See, the portfolio beta, the weighted average of the beta of the individual security, can be altered by adding, removing the securities, can also be altered with the borrowing investment in the risk-free security. See, our concept is talking about computation of the portfolio beta and weight of the portfolio for target beta, security, beta, weight, product. Security, beta, weight, product. Now, the return, friend, the return, see friend, the return, fair return, equilibrium return. What return should we security give? The fair return is equal to RF plus actual beta into RM minus RF. Understand? My dear friend, understand? Yes, you understood. See, actual return, what return security is actually giving. So the beta, the fair beta, equilibrium beta, what beta should security have for the return it is giving? Actual return is equal to RF plus fair beta into RM minus RF. Actual beta is calculated by given elements. What are those? Fair return, equilibrium, actual return, all this. And market. Friend, see the concept of the fair equilibrium return and fair equilibrium beta, the risk of the portfolio relative market, risk of portfolio relative to market, optimum risk, actual beta is equal to fair beta, high risk, actual beta greater than the fair beta. Low risk, actual beta less fair beta. Friend, decision on purchase or sell. Purchase, when the stock, when I will purchase, tell me friend, I will buy the stock when it was undervalued. When I will sell, when it was overvalued. So this significance you can understand by what I want to tell you. See, one thing, undervalued means what? Your expected return is lesser than the fair return undervalued. Your expected return is higher than the expected return is higher than the fair return overvalued. Understand, my dear friend? Yes, you will understand. See, there are two kind of markets. One is bull market, one is bear market. The bull market will goes up, invest in high beta stock. Why? Beta itself risk, where high risk is there, return also is there. That's why they went through high beta security stock. Okay, friend. Let rethink the subject matter of discussion. See, in the bull market, what happened? Invest in high beta stock, higher positive return. That was the intention of the bull market. Whereas bear market, two things happen. Friend, I would like to tell you, let me drink water, cup of water. Dear friend, my dear friend, this is People's Advocate Sriman Narayana. The People Advocate mission is to serve the people, to honor the people, and make awareness to the law everyone. Highest satisfaction in the judiciary is to understand and do justice to the common man. So, so the procedurally, the bear market, the market will go down, invest in the low beta stocks. When the market is going down, I will invest where low beta. Understand? See the beta of bullish and bearish market. Okay. See, friend, a systematic and unsystematic risk computation. A systematic risk is equal numerator of 2 beta and computation, whereas unsystematic risk, the risk specific standard deviation and residual risk, random error, the total risk minus systematic risk. Okay, friends. Friend, the systematic risk and unsystematic risk computation. A systematic risk is a numerator of the F2 of beta computation, whereas the total risk, if you go through variance approach, if you go through variance approach, total risk is equal to, in the variance approach, variance of the security. In the standard deviation approach, standard deviation of the security. Whereas a systematic risk 10 plus, sorry, systematic risk is equal, standard systematic risk is equal to beta of the security into standard deviation of the market whole square. Friends, sorry, what I'm telling here, you want to compute the total risk of the stocks. Then there are two approach. One is variance approach, another one is standard deviation approach. In the variance approach, variance of the security is the total risk. Whereas the standard deviation of approach, standard deviation of the security. Now, how to compute systematic risk? The systematic risk in the variance approach, beta of the security into standard deviation of the market whole square. Here, correlation, sorry, okay, off now. See, systematic risk in case of variance approach, beta of the security into standard deviation of the market whole square, and B in case of standard deviation approach, beta of security into standard deviation of market or standard deviation of security into correlation of security. Rather than like this, you remember like this, beta of the security into standard deviation of the market is standard deviation approach. Friends, I would like to tell you the portfolio risk in the Markevich approach, how to compute. In the Markevich approach, A plus B whole square formula. A square plus B square plus 2AB is the A plus B whole square formula. Whereas Sharpe approach co-movement of the security with index, the total risk of the variance is equal to systematic risk plus unsystematic risk. The systematic risk of portfolio, same as it discussed earlier, we discussed. See, the coefficient determination under variance approach, under SG approach. Variance approach is called a systematic risk as per the variance approach divided by total variance. Understand, my dear friend who watching this YouTube channel, Mr. Mankanta? Our objective is to familiar with the formulas, to familiar with the concepts, to familiar with the what is there in the subject. Thereafter, we are going to solve individual problem. Each problem we are going to take with a significant of time. My dear friends, tomorrow onwards, we'll talk much on other part of the subject. That's called in the years, that's called motivation, this and that, everything in the world. Dream is life, life is dream. The dreamer should struggle for the dream to become success. Everything is possible. The man who can believe. So that we'll talk tomorrow. Depend of the few things I will take in my brain and I'll talk in front of the camera. But today is our target to complete the portfolio management problems and solutions, to understand the theoretical based, to solve the practical problems. See, the correlation square is a systematic risk as per the variance approach. A systematic risk as per the variance approach divided by total variance. The correlation R is equal to systematic risk as per standard deviation approach divided by standard deviation. Coefficient of determination, investment with margin of 60 percentage. Investment in risky portfolio is equal to 160 percentage. Borrowing is equal 60% at risk free rate. Borrowing is equal to 60% at risk free rate. Investment with margin of a fully diversified portfolio carries no unsystematic risk. A standard deviation is equal a systematic risk of the portfolio. Friends, Friend, okay. See, unsystematic risk of the portfolio is equal weighted average of the individual unsystematic risk with the weights being assigned weights. So the coefficient determination under the variance approach R square is equal a systematic risk as per the variance approach divided by total variance. R is equal to systematic risk as per standard deviation approach divided by standard deviation. See, my dear friend, coefficient of determination. Investment with margin of 60 percentage. Investment in risk portfolio is equal to 160 percentage. Borrowing is equal to 60% at risk free rate. Investment with margin XX is equal fully diversified portfolio carries no unsystematic risk. Standard deviation of the systematic risk of the portfolio, standard deviation is equal a systematic risk of the portfolio. A fully diversified portfolio components of return due to market risk is equal to RM minus RF. Return due to extra risk taken, CAPM return for given beta minus CAPM return for beta. Return due to sheer skill of manager, actual return minus CAPM return. Okay. Components of return due to market risk R minus RF. Return due to extra risk taken, CAPM return for given beta minus CAPM return for one beta. Return due to sheer skill of manager, actual return minus CAPM return. Characteristic line CML, security market line, characteristic line stock specific. Characteristic line is equal to alpha plus beta into return of market. It is a stock specific. It is a stock specific. Characteristic line, a stock specific. So the characteristic line is equal to alpha plus beta into return of the market. Security market line common for all companies RF plus beta into R minus RF. Whereas a capital market line common for all companies RF plus standard deviation of security divided by standard deviation of the market. RM minus RF. A characteristic line, sorry, a characteristic line of the and security market line. See, alpha always like this. Alpha always like this. Alpha is equal to, alpha is equal to return earned in excess of the required return. This is also known as return due to sheer skill portfolio manager. Alpha is equal actual return, required return. How is required return calculated? The CAPM approach, diversified, and CML approach, undiversified. Characteristic line. Alpha is equal actual return minus required return. How is required return to be calculated? One is CAPM approach in the diversified, another one is CML approach undiversified, another one is characteristic line. See, alpha, RF and RM computation through two securities. For two securities market line, equations with beta and return gives in question. Solve equation to get risk-free rate and market return. See, return under APT. A CAPM is a single factor model and APT is a multi-factor model. RF plus the factor 1 into the risk or return. The premium of the factor 1 plus factor 2 into risk or return premium of the factor 2 plus factor 3 into risk or return premium of the factor 3. RF plus expected value minus actual value of the factor 1 into beta of the factor 1 plus expected value minus actual value of the factor 2. Beta of the factor 2. Expected value minus actual value of the factor 3 into beta of the factor 3. Arbitrage pricing theory. Beta asset side, beta liability side. Asset side beta or unlevered beta, weighted average of the beta of various assets. Asset to beta of our company is equal to asset to beta of the proxy is equal to liability of the beta of the proxy. Weighted average of the beta of various liabilities, weights for debt would be taken as a debt into 1 minus tax rate. Weighted average of the beta of various assets. Asset to beta of proxy is equal to liability beta of the proxy. Weighted average of the beta of various liabilities. Weights for debt would be taken as a debt into 1 minus tax rate. Beta and leverages. Beta classification, asset beta or unlevered beta or overall beta. Use it to a compute cost of the capital. That's called weighted average cost of capital. The beta classification, asset to beta or unlevered beta or overall beta, used to compute cost of capital, weighted average cost of capital. Equity beta, levered beta, stock beta, used to compute cost of equity. Portfolio strategies. See, the portfolio strategies: buy and hold strategy, no rebalancing done. Constant mix policy, rebalancing at every event, fixed period, fixed change. Constant portfolio insurance, CPPI, rebalancing is done at every event. Investment in equity is equal to multiplier into total value minus floor value. Floor value is equal to total investment minus maximum percentage of fall in the Nifty. Portfolio strategies: minimum risk portfolio, two securities, weight 1 is equal variance of minus covariance of 1 and 2, uh, variance correlation minus covariance of 1 and 2 divided by variance 1 plus variance 2 minus 2 into covariance of 1 and 2. In case 3 securities, critical line approach, more than 3 security, sharp optimum optional portfolio approach. See, the critical line approach, find two portfolio which are on minimum risk. The critical line approach, 3 securities, fit an equation which links weights of 2 securities. Weight of security 1 is equal to A plus B, weight of security 2. Use the equation and find the weights for the third portfolio with minimum risk. Critical line approach. Thank you, Durga Bhavani madam. Durga Bhavani madam. More than 3 securities. Step 1, rank of the securities in the order of the Trainer ratio. Step 2, rearrange in the order of ranking. Step 3, compute the cutoff point. Step 4, maximum of cutoff is taken as a final cutoff security with the trainer greater than cutoff forms part of the final portfolio. Step 5, a compute Z value and final weights in proportion of Z value. Step 1, rank of securities in the order of trainer ratio. Step 2, rearrange in the order of ranking. Step 3, compute the cutoff point. Step 4, maximum cutoff is taken as final cutoff security with the trainer ratio greater than cutoff form part of the final portfolio. Step 5, compute Z value and final weights in proportion of Z value. More than 3 securities, security, trainer ratio, beta, user, SR, SR by USR, trainer ratio into C. See, my dear friend. Thank you, Durga Bhavani madam, who commented on my YouTube channel. Thanks. Thank you very much. See, more than 3 securities, how to compute? You go column number 1 security, column number 2 total risk, column number 3 beta, column number 4 unsystematic risk, column number 5 systematic risk, column number 6 systematic risk by systematic risk divided by unsystematic risk, column number 7 total risk into systematic risk divided by unsystematic risk, column number 8 sigma of the systematic risk divided by unsystematic risk, 1 plus sigma systematic risk divided by unsystematic risk, and cutoff. TR is a Trainor ratio. USR unsystematic risk, SR systematic risk, beta into variance of the market. Cutoff is column number 8 and column number 10. Security, Trainor ratio, beta. First column number 1 security, column number 2 Trainor ratio, column number 3 is the beta, column number 4 used unsystematic risk, column number 5 systematic risk by unsystematic risk, column number 6 systematic risk by unsystematic risk, column number 7 Trainor ratio to systematic risk by unsystematic risk, column number 8 Trainor ratio to systematic risk by unsystematic risk, column number 9 systematic risk by sigma into unsystematic risk, column number 9 1 plus sigma systematic risk by unsystematic risk, column number 9 cutoff. Z value of the computation. Z value is equal to excess cutoff beta divided by systematic risk. Excess cutoff Trainor ratio minus cutoff point. Real estate valuation based on credit side of the profit and loss account, sales comparison approach, value of the property is equal to area into adjusted selling price per square feet based on depth side of the P&L cost approach, area into construction cost per square feet based on income credit minus debt, value is equal perpetual income divided by capitalization rate based on cash flow, present value of the cash flow discounted at required rate of return. Dear friend, now next class by 2:30 we'll rejoin. We are going to talk about Indias. Thank you and all. You please come back to see my videos. Thank you. Thank you much.